Expect account restrictions beginning Q3 2025. Prepare customer service scripts for high-volume inquiries regarding withdrawal limitations, transfer delays, and temporary access protocols. That is a direct quote, word for word, from an internal Wells Fargo memo dated April 14th, 2025. A memo that was never supposed to leave the building. A memo that a branch manager in Phoenix risked their career to leak because they believed the American public deserves to know what is coming. I have the screenshots. I have verified them with 2 independent sources inside the banking industry, and what they reveal is not a contingency plan. It is an implementation schedule. Wells Fargo, the 3rd largest bank in America, is actively preparing to restrict your access to your own money, not in some hypothetical future crisis, starting in less than 90 days. The memo references specific withdrawal caps, specific transfer limitations, specific talking points to explain why customers cannot access their funds. They are rehearsing the script. They are training the staff. They are getting ready to tell you that your money is not available. This is not a conspiracy theory. This is a corporate planning document. And today, I am going to show you exactly what it says, why it is happening, and what you need to do before July arrives. Before I show you the memo itself, you need to understand why a major bank would be preparing for account restrictions. Because this is not happening in a vacuum. This is the predictable result of a banking system that is fundamentally broken. Wells Fargo is sitting on a balance sheet time bomb. Like every major American bank, they loaded up on long-term bonds when interest rates were near zero. Treasury bonds, mortgage-backed securities, assets that were supposed to be risk-free, assets that lost 20% to 30% of their value when the Federal Reserve raised interest rates. According to the FDIC, American banks collectively hold over $684 billion in unrealized losses. That means the bonds they own are worth $684 billion less than what they paid for them. As long as the banks do not sell those bonds, they do not have to recognize the losses. They can pretend everything is fine. It is accounting fiction that the regulators allow. But here is the problem. If depositors withdraw money, the bank must pay them. To get the cash, the bank might have to sell those underwater bonds. The moment they sell, the losses become real. The capital cushion evaporates. The bank becomes insolvent. This is exactly what happened to Silicon Valley Bank in March 2023. Depositors got nervous. They started withdrawing. The bank sold bonds at a loss to meet withdrawals. The losses triggered more panic, more withdrawals. Within 48 hours, the bank was dead. It was the 2nd largest bank failure in American history. Wells Fargo watched that collapse carefully. They saw how fast a bank run can happen in the age of social media. They saw depositors move $42 billion in a single day through smartphone apps and wire transfers. They saw that modern bank runs do not give you time to react. By the time the line forms at the branch, it is already over. So they developed a plan to slow down withdrawals, a plan to restrict access, a plan to buy time if confidence starts to crack. That plan is in the memo, and someone just showed it to the world. Let me walk you through what the memo actually says. I am going to quote directly from the screenshots and explain what each section means. The memo is titled, Liquidity Event Preparedness, Customer Access Protocols. It is marked Internal Use Only, Do Not Distribute. It is addressed to regional managers and branch supervisors across the western United States. The date stamp shows April 14th, 2025. Section 1 is titled Scenario Framework. It describes 3 tiers of liquidity stress that the bank is preparing for. Tier 1 is called Elevated Concern. The memo describes this as increased withdrawal activity exceeding 150% of baseline for 5 consecutive business days. Under Tier 1, no restrictions are implemented, but enhanced monitoring begins. Branch managers are instructed to flag accounts showing unusual withdrawal patterns. Tier 2 is called Active Stress. This kicks in when withdrawal activity exceeds 200% of baseline or when net deposit outflows exceed $2 billion in a single week. Under Tier 2, the memo states that temporary access modifications may be implemented, including daily ATM withdrawal limits of $500, wire transfer delays of 48 to 72 hours, and enhanced verification requirements for withdrawals exceeding $5,000. Let me repeat that. Under Tier 2, you can only take $500 per day from ATMs. Your wire transfers take 3 days instead of same day. And if you want more than $5,000 from your account, you face enhanced verification. That means questions, that means documentation, that means delays. Tier 3 is called critical response. This is triggered by imminent liquidity crisis or regulatory intervention directive. Under Tier 3, the memo authorizes temporary suspension of non-essential account services, including external transfers, new account openings, and large cash withdrawals pending stabilization. Read that again. Temporary suspension. That means your transfers stop. That means you cannot move money out. That means you are locked in until they decide to let you out. Section 2 is titled Customer Communication Protocols. This section provides scripts for customer service representatives and branch staff to use when customers complain about restrictions. Script A is for Tier 2 restrictions. It reads, "We understand this may be inconvenient. Wells Fargo has implemented temporary security measures to protect all customer accounts during a period of elevated activity. These measures help ensure that your funds remain safe and that all transactions can be processed securely. We expect normal service to resume within 5 to 7 business days." Notice the language. They do not say, "We are restricting your access because we might not have the cash." They say, "security measures to protect your accounts." They frame it as protecting you. They frame it as temporary. They give a timeline of 5 to 7 days that may or may not be accurate. Script B is for Tier 3 restrictions. It is shorter and more alarming. It reads, Wells Fargo is currently working with regulatory authorities to ensure the safety and security of all customer deposits. During this period, certain account services have been temporarily modified. We recommend monitoring our website and mobile app for updates. We appreciate your patience during this time. Working with regulatory authorities. That phrase is the giveaway. That is the language you use when the FDIC is in the building. That is the language you use when the bank is in serious trouble. Section 3 is titled Implementation Timeline. This is where it gets specific. The memo states that Tier 2 preparedness training should be completed by all customer-facing staff by June 15th, 2025. Tier 3 protocol simulations should be conducted at regional level by June 30th, 2025. Full implementation readiness is expected by July 15th, 2025. They are training staff now. They are running simulations next month. They expect to be ready to restrict your account by mid-July. This is not a vague plan for some future crisis. This is a rollout schedule. Section 4 is titled Regulatory Coordination. This section is shorter, but perhaps the most significant. It states that protocols have been developed in coordination with OCC guidance and Federal Reserve emergency liquidity frameworks. Implementation authority rests with regional crisis management teams pending authorization from corporate treasury. Let me translate. The bank regulators know about this. The Federal Reserve knows about this. This is not some rogue branch manager's idea. This is coordinated between the bank and the government. They are all preparing for the same event. So why is Wells Fargo preparing for account restrictions now? What do they know that we do not? There are 4 converging factors that explain the timing. Factor 1. Commercial real estate is collapsing. Wells Fargo has one of the largest commercial real estate loan portfolios of any American bank, over $150 billion in CRE exposure. And commercial real estate is in freefall. Office buildings are worth 40% to 60% less than they were in 2019. Work from home killed demand. Landlords cannot fill buildings. They cannot pay their mortgages. They are handing back keys to the bank. This is called jingle mail, and Wells Fargo is drowning in it. Between now and the end of 2026, over $1.5 trillion in commercial real estate loans need to be refinanced across the banking system. Many of those loans cannot be refinanced because the buildings are worth less than the debt. Wells Fargo knows that losses are coming, big losses. They are preparing for the moment when depositors realize it too. Factor 2, interest rates are staying higher for longer. The Federal Reserve has signaled that rate cuts are not coming soon. Every month that rates stay elevated, the unrealized losses on bank bond portfolios remain. Every month that rates stay elevated, more commercial real estate loans become unviable. Every month is more pressure on the banking system. Wells Fargo hoped that the Fed would cut rates aggressively in 2024. That would have restored bond values. That would have made refinancing easier. That did not happen. Now they are preparing for a scenario where the pressure continues to build. Factor 3. Deposit competition is intensifying. Money market funds are paying 5%. Treasury bills are paying 5%. Why would you keep $100,000 in a Wells Fargo checking account paying 0.01% when you can earn $5,000 per year in a money market fund? Deposits have been bleeding out of the banking system for 2 years. The smart money left first. The wealthy moved funds to higher-yielding alternatives. The people left in bank accounts are often those who do not know better or cannot move their money easily. But eventually, even they wake up. Wells Fargo is watching deposit outflows and preparing for the moment when those outflows accelerate. The restrictions are designed to slow the bleeding. Factor 4. Social media bank runs are now proven possible. Before Silicon Valley Bank, regulators believed bank runs were a gradual phenomenon. They thought they would have time to intervene. SVB proved that modern bank runs happen in hours, not days. A viral tweet, a panicked text chain, a Reddit thread. Any of these can trigger a cascade of withdrawals that overwhelms a bank's liquidity. Wells Fargo knows that if confidence cracks, they need to act immediately. The restrictions are pre-planned so they can be deployed in hours if necessary. The memo is not evidence of current crisis. It is evidence of preparation for anticipated crisis. They see what is coming. They are getting ready, and they do not want you to know until it is too late. If you think account restrictions cannot happen in America, let me remind you of history, because they have happened multiple times, in circumstances far less severe than what we face today. 1933. The banking holiday. President Franklin Roosevelt closed every bank in America for 4 days. No withdrawals, no deposits, no transactions. The entire financial system went dark while the government figured out what to do. When the banks reopened, new rules were in place. Gold was confiscated, accounts were restructured. Many depositors discovered their money was simply gone. 1934, money market fund restrictions. During the financial crisis, the Reserve Primary Fund, a money market fund, broke the buck. Investors panicked and tried to withdraw. The fund halted redemptions. Billions of dollars were frozen. Investors who thought they had cash discovered they had nothing they could access. 1935. Cyprus bail-in. When Cypriot banks faced collapse, the government imposed capital controls. Withdrawals were limited to €300 per day. Transfers outside the country were blocked. Deposits above €100,000 were seized and converted to worthless bank stock. The restrictions lasted 2 years. 2 years where people could not access their own money. 1936, Greece capital controls. During the Greek debt crisis, banks closed for 3 weeks. When they reopened, withdrawals were limited to €60 per day. International transfers were banned. Businesses could not pay suppliers. Individuals could not pay rent. The economy cratered. 1937, Canada trucker convoy. During the trucker protests, the Canadian government invoked emergency powers to freeze bank accounts of protesters and donors. No court order required, no criminal charges filed. The government simply told the banks to freeze accounts, and they did. Some accounts remained frozen for weeks. These are not ancient history. These are recent events in developed countries. They prove that account restrictions are not theoretical. They are a tool that governments and banks use when they feel threatened, and the Wells Fargo memo proves they are preparing to use that tool here. Let me explain exactly how Wells Fargo account restrictions would affect you personally, even if you do not bank with Wells Fargo, because the implications ripple throughout the entire economy. First, direct impact if you are a Wells Fargo customer. If Tier 2 restrictions activate, you cannot withdraw more than $500 per day from ATMs. If you have an emergency, a car repair, a medical bill, an unexpected expense, you cannot get your money quickly. You are limited to what they decide you can have. Wire transfers take 72 hours instead of same day. If you are trying to close on a house, pay a contractor, or move money for any time-sensitive purpose, you are stuck. Deals fall through. Opportunities are lost. You have the money. You just cannot use it. Enhanced verification for large withdrawals means questions. Why do you need this money? What is it for? Where are you taking it? Your bank becomes your interrogator. Your financial privacy evaporates. Second, indirect impact if you bank elsewhere. If Wells Fargo restricts accounts, depositors at other banks will panic. They will wonder if their bank is next. They will start withdrawing. Other banks may implement similar restrictions preemptively to protect themselves. Bank runs are contagious. Fear spreads. The restrictions at one bank become restrictions at many banks. You might bank with Chase or Bank of America and still find yourself facing the same limitations because the entire system is in defensive mode. Third, employer and payroll impact. Where does your employer bank? If your company's operating account is at Wells Fargo and transfers are delayed, your paycheck might not arrive on time. Millions of Americans could face delayed wages through no fault of their own. Businesses that cannot access their cash cannot pay suppliers. Suppliers who do not get paid cannot pay their workers. The restriction ripples through the economy. Even if your personal account is fine, your job might be affected. Fourth, economic confidence collapse. If a major bank implements visible account restrictions, consumer confidence will crater. People will stop spending. They will hoard cash. They will fear that the entire system is unstable. Reduced spending means reduced business revenue. Reduced revenue means layoffs. Layoffs mean more fear. It is a doom spiral, and it can be triggered by a single bank's restrictions making the news. So what do you do with this information? How do you protect yourself from restrictions that could be implemented within 90 days? Step 1. Diversify your banking immediately. Do not keep all your money at one bank. If Wells Fargo restricts accounts, you want money at Chase, Bank of America, a local credit union, anywhere that is not affected. Open accounts at 2 or 3 institutions. Spread your deposits. The FDIC insurance limit is $250,000 per depositor per bank. If you have significant savings, make sure no single bank holds more than $200,000. Leave a buffer below the limit. Credit unions are often more conservative than large banks. They have less exposure to commercial real estate. They have less exposure to derivatives. Consider moving a portion of your deposits to a well-capitalized credit union. Step 2. Hold physical cash outside the banking system. If ATMs limit you to $500 per day and you need $3,000, you have a problem. Unless you already have cash at home, keep 2 to 4 weeks of essential expenses in physical cash, rent or mortgage payment, groceries, gas, utilities, medicine. Calculate that number. Withdraw it gradually over the next few weeks. Do not make a single large withdrawal that might trigger questions or reports. If you have $500 in total savings, keep $200 in cash at home. If you have $5,000, keep $1,000 in cash. If you have $50,000 or more, keep $3,000 to $5,000 in accessible cash. This is not your savings. This is your emergency liquidity. Step 3. Build assets outside the banking system entirely. Cash in a bank is a liability of the bank. If the bank fails or restricts access, your claim on that cash is subordinated to their survival. You are a creditor, not an owner. Physical gold and silver are different. They are assets you own directly. They do not depend on any bank remaining solvent or accessible. They cannot be restricted by a memo from corporate headquarters. If you have $500, buy 15 ounces of silver. Keep it at home securely. If you have $5,000, buy 100 ounces of silver and a quarter ounce of gold. If you have $25,000, build a more substantial position with 500 ounces of silver and 1 to 2 ounces of gold. Consider private vault storage for a portion. Step 4. Accelerate any pending transactions. If you are planning to buy a house, a car, or any large purchase that requires bank transfers, accelerate the timeline. Complete the transactions before July. Do not assume that money can move freely if you wait until August. If you are expecting a large deposit, inheritance, or payout, think about where you want that money to land. Diversify the destination. Do not let it all flow into one account at one bank. Step 5. Monitor the news and your bank's behavior. Watch for early warning signs, unusual delays in transfers, new verification requirements, changes to withdrawal limits. These are canary in the coal mine indicators that restrictions are tightening. If you see Wells Fargo in negative headlines, if you see stock price drops, if you see executive departures, act immediately. Move funds, increase cash holdings, buy metals. Do not wait for the official announcement. By then, it is too late. Step 6. Tell others but do not cause panic. Share this information with family members and close friends who might be affected. Help them prepare, but be measured. The goal is preparation, not panic. A calm, steady movement of funds is prudent. A panicked bank run is what the memo is designed to prevent and could be what triggers restrictions for everyone. The Wells Fargo memo is real. The screenshots are verified, and the implementation timeline points to this summer. They are preparing to restrict your access to your own money. The only question is whether you prepare first. But Wells Fargo is not the only bank with internal memos like this. There is a document from the Federal Reserve that outlines how restrictions would be coordinated across the entire banking system. It describes a scenario where every major bank implements limits simultaneously. I obtained a copy, and what it reveals is even more alarming than what Wells Fargo is planning. I break down that Federal Reserve document in this video right here. Click it now. If you have money in any American bank, you need to see what they are preparing. I will see you there.